You're listening to this podcast, so I know you've got a curious mind. Here's a helpful fact you may not know yet. Drivers who switch and save with Progressive save over $900 on average. Pop over to Progressive.com, answer some questions, and you'll get a quick quote with discounts that are easy to come by. In fact, 99% of their auto customers earn at least one discount. Visit Progressive.com and see if you can enjoy a little cash back. Progressive Casualty Insurance Company and Affiliates. National average 12-month savings of $946 by new customers surveyed who saved with Progressive between June 2024 and May 2025. Potential savings will vary.
This episode is brought to you by Indeed. Stop waiting around for the perfect candidate. Instead, use Indeed sponsored jobs to find the right people with the right skills fast. It's a simple way to make sure your listing is the first candidates see. According to Indeed data, sponsored jobs have 4 times more applicants than non-sponsored jobs. So go build your dream team today with Indeed. Get a $75 sponsored job credit at Indeed.com/podcast. Terms and conditions apply.
I mean, you're living in your mother's basement writing a blog on finance. Really, you should stay off the computer, son, and get a job. Seriously.
Live from the basement of the YouTube headquarters, it's the Stacking Benjamin Show. I'm Joe's mom's neighbor, Doug, and they say that those who don't learn from history are destined to repeat it. So what can we glean about setting up our portfolio from the stock market crashes of the last 130 years? We'll pick several and walk through case studies of how best to weather those storms. Plus, because it's Friday, you know what that means? I've fired up my trivia engine, and we'll see which of our contributors can climb the mountain to be today's champion. And now a guy who still believes in the latte factor, but only because he just spilled one on his keyboard. It's Joe Saul-Sehy.
So it's a fun way to start your Friday, Stackers. You get a phone call, you didn't expect it, you knock over the cup, and it's time to get a new keyboard. Welcome to Friday. I'm super happy that you're here. Sit back and relax. We haven't done a history lesson, Doug, in a long, long time, so.
Gather round, kiddies.
And we have never studied some of the biggest stock market crashes. But before we do that, on every Friday episode, this is a great chatty episode to end each week. We've got 3 contributors who are amazing podcasters in their own right. We will introduce our guest of honor. Is she really a guest of honor? She has a frequent flyer card here on the Stacking Benjamin Show. But let's introduce her last. We're going to start with a guy across the card table from me. Mr. OG is showing up for work today. How are you, man?
Who doesn't like to work on a Friday in the summer? So excited to be here. Thank you for including me today.
In Texas, it's not bad. I would love it if people could actually hear the bubbles from the hot tub as you're sitting in the hot tub recording.
Well, this time of year, it's a cold plunge. But
cold, well, true. Good point. The hot tub is just the sweat around you outside as you go for a walk down the street. And the guy who's a walking hot tub of financial information, Jesse Cramer's here. Maybe not my best segue, dude.
No, one of your better segues. There's a lot of imagery that comes with being a walking hot tub, and a lot of that imagery applies to me. So I'm on board. I've got jets. I've got bubbles. I've got a bad filter. I mean, where can we keep going? Can we keep going with this?
So, was this your last health checkup we're talking about?
I need to be cleaned. I need to be clean. I need to be scrubbed vigorously. And some scantily clad women sat on me last night.
Whoa.
And that's how you end the show.
Was I saying something about a filter?
Yeah, I think that filter needs to be replaced. And the woman who's never been accused of needing her filter to be replaced. Actually, she probably.
Have you heard me? Are we allowed to swear on this show?
I've worked with this woman for a long time. She also has no filter a lot of the time. Miranda Marquit's here. How are you, man?
Doing great. I am not planning on hopping in the hot tub, but as soon as we're done with this, I'm going to escape to the mountains.
Oh, show off.
Nice.
That's what we do here in Idaho. We just escape to the mountains.
Talk about just relaxing fun and not Texas heat all in one.
Exactly. And once you get to the certain places in the mountains, then I can be the scantily clad woman Jesse dreams about. It'll be amazing.
I like it.
What is happening?
And now Jesse's flying to Idaho. There we go. For people, Miranda, that don't know all the fine work that you do, you write for some of the finest publications. You've written for just a ton of personal finance publications, but you also do financial coaching. You have some excellent mini courses. Let's talk about Miranda for a minute.
Oh, yay. No. Yeah, I just have a couple mini courses on Gumroad. A lot of people ask me about my travel fund, and a lot of people ask me about putting together my financial priorities. So I just went ahead and saved myself some time, made some mini courses, threw them up there, and there they sit.
Isn't it great? It's like Miranda gets her FAQ and she's like, you know what? This will save me some time and maybe help a bunch of people at the same time.
Yeah, so just it's fine. And then some people asked me if I did coaching, and I didn't think that I did. So then I said yes to one person, and it turned out I liked it. So now if you ask me, I'll do it, but I'm not out there like advertising it. I mean, does that sound like me? It's like, oh, I'm doing things.
Except on the, yeah,
you can ask me about it and hand me some money, but I'm not going to
I was going to say, Miranda, this sounds like a hard sell to me. I kind of, but yeah, I don't know.
If I like you, I'll do it.
You were doing some work with a life insurance company. You were talking about just how fun being Miranda Marquit salesperson is just not where you want to be. Oh, yeah, no,
they canceled the contract with me because I couldn't meet my sales quotas. Because I was doing things like I would go into a meeting with my trainer, and then I'd leave the meeting and text them and say, hey, babes, you don't want this whole life insurance policy. Just put more money into your IRA. Bye.
Oh, my God. Well, why would you be with a company? You, of all people, why would you be with a company offering whole life insurance?
And I'm not anymore.
Yeah.
It was a fun experiment. I learned a lot. We're not doing that anymore.
It's like a Trojan
but I still
horse.
have an insurance license, so I can talk about it. But I'm not with the company anymore. No.
Miranda goes in there representing a whole life insurance company just to disrupt sales. They're like, why are sales down so much? Oh, because Miranda was here. All right. Well, we're going to talk about history and what we can learn from some of the biggest downturns in history. This was a wonderful piece from Morningstar. We're going to dive into that. But first, we've got a couple of sponsors to make sure that we can keep on keeping on, and you don't pay a dime for any of this walk down history lane goodness. We're going to hear from them, and then Miranda, Jesse, OG, Doug, and I going to walk through some of the biggest market crashes in history and what could we glean from them. You may not know that when we started Stacking Benjamins, it was a blog. And even then, just the startup cost, I remember thinking, is this the right thing? And what if I write things and nobody comes, right? Well, luckily, that didn't end up happening. But starting something new isn't just hard. It's terrifying. There's so much work. You're not sure whether it's going to work out. You're not sure if anybody's going to read it. And then we change it to a podcast. Is anybody actually going to listen, right? What if nobody wants all the stuff that we have? Well, had I used Shopify, it would have been even easier because with their expertise, their helpful tools, and their easy to use platform, that's something that would have made Stacking Benjamins more effective much, much more quickly. Shopify is the commerce platform behind millions of businesses around the world and 10% of all e-commerce in the U.S. Names you've heard of like Heinz and Mattel, Shopify, Gymshark, Aviator Nation, Allbirds, also all Shopify. Get started with your own design studio with hundreds of ready-to-use templates. Shopify helps you build a beautiful online store that matches your brand style. And best yet, Shopify is your commerce expert with world-class expertise in everything from managing inventory to international shipping to processing returns and beyond. And did I mention that iconic purple Shop Pay button? It's used by millions of businesses around the world. It's why Shopify has the best converting checkout on the planet. It also helps boost conversions, meaning less carts going abandoned and more sales for you. So you're stacking Benjamins much more quickly. Time to turn those what ifs into with Shopify today. Sign up for your $1 per month trial today at shopify.com/SB. Go to shopify.com/SB. That's shopify.com/SB. Dell PCs with Intel Inside are built for the moments you plan and the ones you don't. They're for those all-night study sessions, the moment you're working from a cafe and realize every outlet's taken, the times you're deep in your flow and can't be interrupted by an auto update. That's why Dell builds tech that adapts to you. Built with long-lasting batteries so you're not scrambling for an outlet, and built-in intelligence that makes updates around your schedule, not in the middle of it. Find technology built for the way you work at Dell.com/Dell PCs. Built for you. is written by Amelia Fredlich, and Amelia writes, what we've learned from 150 years of stock market crashes. And for people with us on YouTube, I'm putting it up on the screen. Miranda, let's start with you. The first thing that I notice is they show this wonderful graph. The graph, by the way, starts in the late 80s. And then we look at 2000 through the next 10 years. They call that the lost decade. The COVID-19 pandemic, Ukraine, inflation, shortages, like all these downturns, Miranda. But there's something else that's even more prominent when you look at this thing.
It's all going up overall. I get people come to me and they say, oh, I was worried about the market crashing, so I moved my money into some cash and bonds. And aren't you so proud of me? And I'm like, no, I'm not.
Yeah, please, no.
Please,
what are you doing?
Why did you do this? Why did you not talk to me first? Our system is basically set up to promote a stock market recovery. If we ever get to the point where the system is not promoting a stock market recovery, well, then we've got bigger problems than what is money. So,
might as well grab your gun in a cave.
I have a gun, so I'm good. I got my gun and my fishing tackle. I am ready to go.
And you go hiking a lot, so you know where the caves are.
Yes, exactly. Overall, the stock market goes up. If you look things out and zoom out to like a 20-year period, the stock market's not ever been negative in a 20-year period. So keep on keeping on, right? Stay the course.
I asked you the question. B hanging out with us live on YouTube says, Miranda took my line. But B, I think it's pretty easy for people hanging out with us live. Jesse, let's zoom out. I went down to the next graph. Now we look at the 1870 through present, and we've had some bigger things than the lost decade. I mean, there was World War I, World War II, the Great Depression. We've got Vietnam, Watergate, all these things. And yet, Jesse, there's something else you can see when you look at this graph.
Well, it's a really powerful graph, first off. And I was going to say, when I was a young guy and I bought my grandmother some jewelry, that was a silver agitation, much like, what is that, 1898, 1894, the silver agitation. Of course, we all remember that one.
Problems in the silver market.
Well, one interesting thing about this particular graph that's worth pointing out, right? This shows inflation adjusted returns. This is real returns, not nominal, because I think it's powerful. And the thing that I see, and it's not that this pattern will always repeat itself, but I see 4 periods where real returns were more or less flat for a decade or more, right? So that's Great Financial Crisis and inflation and Great Depression, blah, blah, blah. So from my point of view, it's something I like talking about is the fact that those kind of periods can happen again. And part of being a stock investor is accepting that fact that it's happened many times before and it'll probably happen again.
Well, and this is the problem, OG, is that Jesse makes a great point that we got these 4 plateaus on this 130-year, 150-year graph. And yet, when you look at the end of all those plateaus, it's like a boomerang. And think about this, though, OG, how many people gave up before that decade of flat ended?
Well, the other thing that's missing from people that aren't looking at this is you can kind of picture what this graph looks like, right? It's up and to the right. From 1870 to present. This is also a logarithmic graph, which means that each level is 10x higher than the level before.
I did not even notice that.
Actually graph it the normal way, you can't even fit it on the screen because $1 in 1870,
way more up.
Yeah, $1 in 1870 is worth $31,000 in 2025 after inflation. So to Jesse's point, we just don't use after inflation numbers in our normal parlance. Like when you're doing your calculations for your retirement plan and you say, I put 10% in my 401k and at some point in time, I'll have $1 million in my 401k. Like you don't think like, well, actually I have 387,000 inflation adjusted. You know what I mean? Like that's what happens clearly, but that's not how we really think about it in real life. So it's an even more profound number. I can't think back to 1870. I don't have a lot of memory from back then.
Are you sure about that?
Yeah, I'm pretty sure. I mean, even the more recent times, like over just the last 50 years from the 1970s is even more interesting because we've had 3 really gigantic ends of the world. And yet the market is up 50 times over that period of time.
It's incredible.
I was just reading a book about this. It's funny that this is the topic because I was just reading a book about the market fluctuations and that sort of thing. And it quoted Josh Brown in there from CNBC and Ritholtz and
the Stacking Benjamin show.
And the Stacking Benjamin show, obviously. He did the calculation and said, if you put $100,000 in the market in the S&P in 1970 and you didn't touch it, and just paid taxes as they were due from some other source, today you'd have 20 million. it's such an incomprehensible number just to do nothing. The other thing that he said, which was I thought really great at the end of last year, he said, any time that you sold in the last 50 years was a bad time to sell.
Anytime.
It just doesn't seem like it in real time.
Well, Kierkegaard, the philosopher, said that life can only be understood backwards. One of my favorite quotes, right? It's afterwards that you go, oh, that's what I should have done.
He was a bright and cheery guy.
But we got to live it forward. So let's go backwards. I'm going to start with way, way, way back, and we'll do 2 before our trivia competition in the middle of the show and then 2 after. Let's start off with World War I and influenza. And this is what
those were the days.
This is what Morningstar says. After peaking in June 1911, markets soon started falling due to the breakups of conglomerates like Standard Oil Company and the American Tobacco Company. They were really going after at this time, all the monopolies. And the worst part happened when World War I broke out in July 1914. A $100 investment dropped to as far as $49.04. This is looking at, by the way, the index. And recovery didn't happen until 1918 influenza pandemic, as if the pandemic was like I don't know if it was a relief or I mean, thank God a pandemic. Now it's going to go up. But let's talk about some of the things that happened then. Let's talk first about this idea, Jesse, of the breakup of Standard Oil and American Tobacco. I think we can kind of learn from that. Like over the short run, that was a bad thing, but it was also a horrible thing if you're a concentrated investor, meaning individual stock investors. If you had picked individual companies, you might have taken on the chin way worse than this 50% drop.
If you're going to invest in individual companies, there are so many risks that probably the average person doesn't even think about or understand. It's like that whole, you don't know what you don't know and you're ignorant to what you don't know. When you hear an actual stock analyst talk about the way they think about a company and the potential risks that that company may face, whether it's in this case like legislative, like government stepped in and basically broke this company apart. Generally, we think about like competitive risks, like, oh, is Costco going to get outcompeted by some other grocery chain? Or we might think about, is Costco overvalued right now? There's this government risk. What if Costco gets hit by an asteroid? I'm kind of making a joke, but it just shows that you have to think about so many things to be a successful investor in an individual company. And unless you're willing to put in the time and effort and kind of put your own money at risk to do so, there might be a better option for you.
I just think about Enron, Jesse. Reportedly, between 4 and 10 people knew the thievery that was actually going on at the top.
Yeah, I mean, total right fraud risk, basically, right? I was speaking with someone the other day who works at Deloitte, and we were talking about because Deloitte, Big Four accounting,
Sure.
and I think Enron was an Arthur Andersen customer, and some of the fallout of the Enron scandal basically means that Arthur Andersen is no more. But just some of the illegal fraud that was going on, and to the outsider, hell, to all the insiders, right? That's what you just said, Joe. Basically, to 99% of the Enron insiders, they didn't even know there was a fraud going on. So, you take a lot of risk when you choose to invest in a single company. No doubt about it.
And yet, OG, when we think about those companies, about American Tobacco and Standard Oil, I mean, the companies that rose from those companies later on, don't get me wrong, over the short term, we can see that created a lot of uncertainty and created a big time market down. But man, when you look at the companies that then sprang up, if you were able to take a longer term view and hang on to some of these new companies that were born, you did very well.
Well, I have a much more comfortable history with more recent times. So I'm going to use that to kind of jump into present, if that's okay.
Sure. No. We want to.
That also backfired in a different way with like the telecommunications businesses, right? So look at like the big divestiture that was required by, the big AT&Ts and all that sort of stuff. And you end up with all these other companies and none of them are around anymore. Whereas in the Standard Oil one, a lot of them were around. This just proves the point. I think what Jesse was getting to, it's very difficult to pick a stock that's a winner and then also going to be the stock that's around for a long time. When I mentioned the 1970s data, investing 100,000, whatever, look at the S&P today and what is dominated by the big 7 tech companies. How many of those were around in 1970?
Totally.
None of them were around in 1970.
Right.
So the biggest, best companies in the US right now were not even thought of at that time. And so not only do you have to like try to find the winner, but you have to hope that that winner stays the winner into your entire investing life, or you end up with this Enron situation or AT&T situation or Standard Oil situation or Kodak or whatever, where this one event all of a sudden, or in Kodak's case, right, a more long-term kind of cyclical thing. But my point is that it's very difficult to find the stock that's going to win and then also be the winner for the next 60, 80 years of your investing life. I don't know how many points of evidence you need on this to be broadly diversified.
By the way, I love how we mentioned Kodak and the guy in Rochester, New York, smiles, grins.
Is there something to do with Rochester? I don't even know.
Painful and long chapter of our history.
Yeah.
Oh, is it from Rochester?
That may be the home of the company, OG.
Yeah. Yeah, you didn't know that, OG? Oh, yeah.
Well, you want to know something that's funny? So my son had a graduation party a couple of weeks ago.
That is funny.
And
oh, sorry.
So funny. Comma, Jesse, thank you very much. I'm in mid-phrase. Joe, you were there. What was the prop du jour that everybody had at their table?
Oh, it was very cool. We had those little instant photos, the
Polaroids
ones that you had to shake, the Polaroids.
Yeah.
Yeah, that's from a different part of New York.
It was super fun.
Whatever.
That might be a different company.
That's
Sweet.
probably a different company, but we'll just roll with it. That's also funny.
Miranda, let's bring you in on this conversation on a different area. I think another lesson from this that I didn't outline, but something that happened here, and that is a lot of the time people go, well, you know what? I don't need an emergency fund or I don't need access to my cash right now. But sometimes the market just stops. In this case, the New York Stock Exchange, after World War I began, actually shut down for 4 months. Now, would that happen today? Hell no. That would not happen today. However, this idea...
Although it did it did for 9/11. It didn't shut down for 4 months.
Not
it shut
for
down
4
for
months, but it shut down for a week. Yeah,
right.
For
that's
longer
4
than
months in 2001 time periods.
Inflation adjusted. That's 4 months, Joe.
Inflation adjusted 4 months. I'm sure it was in terms of trading data and that sort of stuff. Probably way more.
Right.
than
Yeah.
that.
Yeah, for the number agreed. So
Right. Volume and everything. Yeah.
yeah, but this idea that liquidity is guaranteed, like it's just built in, Miranda, is also, I think, not true.
Yeah, and I don't know whether you're singling me out because I do keep a portion of my emergency fund in
Oh,
stocks.
there we go.
Oh,
Now-
boy.
But this is a good
Perfect.
lesson for me. This is great. Normally, as far as cash goes, I've expanded. Back in the day, I used to keep 4 to 6 weeks worth of liquid cash. And then if I needed something for a longer term emergency, then that would give me time to liquidate some of my investments in my taxable investment account. I've actually increased that. I'm up to 2 months now in my emergency fund and working toward 3. Just because when we're starting to think about this and what is liquidity, could we have a long-term sustained issue, right? We talked earlier, right? Talking about, oh, well, it's a bad time to sell. Any time that you sold in the last couple of decades is a bad time to sell. Well, if you have lost your job or you have some other emergency where you don't have your income and the market's down, you don't have a choice but to sell, right? If you're in the middle of your retirement, whatever strategy you're using to have access to ready cash for you, you do not have access. You have to sell while it's down.
Imagine one of these crashes happen, Miranda, and
Yeah.
you need money right now out of your stock portfolio. Like that is
Yeah.
just sucks.
Yeah. I mean, I'm still up. Like my portfolio overall is still much higher than it was 20 years ago when I started investing, right? So overall, I'm still up. I'm still actually not selling at a loss if you're going first in, first out. I'm actually still selling with gains, which is also another interesting way to look at this, right? If you've been in the market long enough, even when the market is down, your portfolio could still be up.
That's a good point. Oh, gee, you were talking about this a couple of weeks ago when you were saying, yeah, now we're selling it just 18 months ago, right? Everybody goes, oh my God, it's down. Yeah, okay, it was 18 months ago. It's not like we were here 16 years ago. We were here a year and a half ago.
Yeah. So I think part of that is, trying to figure out that perspective. But I have been kind of shifting a bigger emergency fund in cash than I have had in a long time. Because I have been using a taxable investment account. I use a taxable investment account for part of my travel fund, just because if I do actually have to sell something at a loss, at least now my trip was tax deductible. But that's a very good point. Having liquid cash, especially in times of uncertainty, makes a lot of sense, because if the stock market is paused and you don't want to have to liquidate something in this climate, then yeah, you need to have some of that cash available.
And once again, going back to the financial crisis that we had, 2007, 2008, a lot of that credit that you thought was your emergency cash reserve was just gone.
Oh, yeah.
Yeah. Let's go into another one of the top 5. We're going to do 4 out of the top 5 today. Let's go to the biggest one, right? 1929. Everybody always goes back to 1929, the crash in the Great Depression. In this Morningstar piece, they write $100 became $21 by May of 1932, about 3.5 years later. The crash occurred when the post-World War I economic boom, which led to overconfidence, overspending, and overinflation of prices, was eventually no longer sustainable. When you dig into this, OG, I mean, there's a bunch of lessons. But I think this, which is booms, and we've seen this since then, right? I'm thinking real estate. I'm thinking of the tech wreck. I mean, things that we're going to talk about later. Booms can lead to bubbles. And getting back to that single stock risk, man, if you've got every dollar in the boom, you got to be waiting for that other shoe to drop.
I think a couple of things here about the Great Depression. I was going to say a Great Recession. Whole different suckiness. Same, but different. And, the -80, right, which is basically, or whatever, -79, I think, from the Depression, really kind of mirrored the Y2K .com bust, with tech stocks was down about the same. And I don't know how much a broadly diversified portfolio would have saved your bacon in this. And I don't know that other market data like international or whatever to say, well, maybe that would have helped. But I think it's a good example of how long it can take to recover and how this is the price that you pay for averaging 10. And we throw that number around like very, very easily of like, oh, well, you did it a couple of episodes ago where you're like, we're doing the
Let's use 9, the rule of 72.
Yeah, we're doing the rule of 72, right. Or maybe you're doing that in a couple episodes. I don't know where the hell this one's being recorded in the whole gamut of all the ones we've done.
Maybe it's coming soon.
But, you toss it around like, oh, I got 9%. Like, well, the price of getting 9% is every so often it goes down by 30. And every so often it goes down by 50. And that's just part of the deal. I think the harder part is, at least with the Depression, it seemed like it recovered. What was the recovery date on the market during the Depression? You rattled it off.
Oh boy. Well, I just had to hit the bottom in 1932.
Okay, so I think the recovery date was in the mid 40s, right?
Hit the bottom. We had, if we go back to the graph, does somebody still have the graph up? Because I got it right here.
Well, I was going to say, it said it reached its thing by 1936, like its previous high by 1936, but then it crashed again.
Yeah, I think Jesse's got it. 1945.
Yeah, so the first recovery, 1936, then World War II, obviously. So maybe those are two separate events or somewhat intertwined, I suppose, which I think maybe is another lesson even. I know you wanted to skip over the World War II one, Joe, but that's another thing. Just because you're out of the woods of this one doesn't mean the next one's not around the corner.
Yeah, good point.
How about the people in 1936 that are like, oh, thank God, I stayed invested. My planner kept me diversified. I'm back to even money. And what's happening in Germany? Who's this guy? What's he want to do? Oh,
yeah, just imagine 1929 to 1945. I mean, there's another thing right there, Jesse. I mean, this role of patience and continually investing, because if you continually were able somehow to keep dollar cost averaging through both of these pits, this Great Depression and World War II, man, you probably cleaned up.
Right. If you could stay the course, right? I mean, you hit the nail on the head, Joe, and we all kind of are. And I'm fast forwarding to the end of the article only because this one line is about the Great Depression, and we're talking about it right here. It says, there's no way to know in the moment whether you're encountering a minor correction or looking down the barrel of the next Great Depression. Still, even if you are looking down the barrel of the next Great Depression, history shows us that eventually the market recovers. And it's like, that's fair, but it's really hard to express to someone, especially if you're just writing it on a page. How do you express to someone it recovers in 16 years? Like 16 years is a long time.
I got good news and bad news.
Well, 16 years ago, I was walking across a high school graduation stage. That's what 16 years is to me. It's so long. So that's the really hard part about, how do you guys feel now?
Nice flex.
Jesse's a little baby.
I know. 16 whole years ago, life was really challenging. Jesse, this is one of the things, and I'm sure you talk about it with your clients as well, especially when it gets to the concentration piece around tech. I love having this stat at my disposal because it mirrors the tech crash in 2000. NASDAQ hit its all-time high in March of 2000, then went down. It also went down 79%, and it recovered in August of 2013. Yeah. And so everybody who says from an investing standpoint, oh my gosh, you don't understand, we don't do value stocks anymore. we have to only be in tech. It's like, we've sung this song before, and I can tell you how the chorus goes. It goes like, in 2038, you're even money. Tell me that between now and 2038, with 80% of your freaking money gone, you're going to go, yeah, dollar cost average. Yep. Stay the course. Like, no one does that. Not even the most stalwart person would do it. It's very hard to be single stock, single technology, single theory investing and not have it blow up in your lap.
Yeah. And this is why I index.
Yeah.
Yes,
I'm too lazy and it's too stressful to not.
That's exactly right, Miranda.
That is a great lesson from this side one. Jesse, you were going to say something?
I was just going to say that was a catchier chorus than I thought you'd be able to pull off, Josh, with your metaphor. In 2038, you even money. Hard rock, OG,
It was like November Rain. Like, that's how I have it envisioned in my brain. Like, it's like a ballad.
All right, can we talk just one more thing briefly, because I'd be remiss if we didn't do this before the break, because I really want to move up the timeline here. But this idea in 1929 also of leverage, Jesse. The 1929 crash came about because people were leveraged to the hilt. They were so exuberant and they're betting the farm.
Literally.
Leverage is awesome in an up market, but even in real estate, Josh Dorkin, the creator of Bigger Pockets, said to me once, he's like, leverage in real estate you saw in 2008 was this giant toilet flushing as you got all the morons out of the market that didn't have a plan.
Yeah. You guys know what Warren Buffett calls leverage? He calls it a financial weapon of mass destruction.
Oh, wow.
All right. And that's totally what it is. And there's this great, I'll see if I can find it and then provide it to you, Joe, and then maybe we can share it with the stackers. There's this amazing letter that I think Warren Buffett wrote to like the SEC in the 70s or 80s when options trading was like exploding. Because options trading, a lot of options trading is just like leverage by another name. It allows you to put some 5-to-1 or 10-to-1 bet on a particular stock or something like that. Buffett was basically saying, like, you are encouraging just this. It's kind of like the Great Depression 2.0 is what he was saying, is where you just have this, you're going to have this rampant leverage in the system. And this other great metaphor is when that all unwinds, it's like a crowded theater with a small door.
Oh.
And you just have this rush for the exit. And the metaphor is kind of cool. It's very scary, but it's kind of cool because then you say, well, how do you get to the front of the line if you're in a crowded theater with a really small door? And in the marketplace, the answer is you offer a lower price. Right? You offer a lower price that hoping that someone will buy it from you, buy your assets from you so you can get to the front of the line. And that is that toilet flushing that all of a sudden just the bottom drops out of a market and you have this gigantic crash out of nowhere. So that's the risk of leverage. And anyway, it's something we all probably need to be aware of because it exists in the market, even if we're not participating in it, right? We have to keep that in mind.
It's a great metaphor. I love that. The only way to move up is put your stuff up for sale.
Right.
Like
fire sale.
Yeah, right. I was going to say, start off with garage sale, estate sale, out on your front lawn for free. The only good news about the Great Depression, didn't think I'd ever say that line, but there was some good news when we look back historically, which is we got the Securities and Exchange Commission. So we were able to take some of the...
Everybody loves the government.
The sketchy stuff. We got FDIC, which saved a lot of people's bacon. And it also birthed this idea, Miranda, that we were talking about earlier of emergency fund, right? Because all of a sudden people are like, I need a safety net. I can't have everything there. So I think that all these systems we're talking about were built on like yesterday's mistakes. And so luckily we've got those in place. We're going to talk next about the Vietnam era and that brutal 1970s with Watergate. And then we're going to go to the lost decade, which started off with the .com crash and then ended with the real estate crisis. Lots of fun today and up. But Doug also has a history lesson here in the middle of the show. And if you're brand new to the Stacking Benjamin Show, we do trivia in the middle of every episode. But on Fridays, it's special because our participants in the roundtable are also taking part in a year-long competition. It is our 3 frequent contributors, OG, Jesse, and Paula Pant. And so, Miranda, today you are Team Paula. And that means, speaking of good news and bad news,
Paula and I are supposed to be friends.
Well, the good news, Miranda, is you can't do worse because Paula, as usual, is in last place.
Oh, good. That takes the pressure off.
There is nothing to worry about here, Miranda. Paula has the least points. Jesse's in second. OG is in first, which means you get to guess last. Jesse guesses in the middle. OG's going to kick it off. But just to lead in, Doug, what is the score in the competition so far?
Well, Joe, we have OG with 8 points, Jesse with 5.5, and Paula pulling up the rear with 4.5.
There it is. All right. So, Miranda, you can help Paula move out of last place and tie Jesse. Or Jesse, you can finally get back. So it's the two of those points that Doc G got last week for who knew, by the way, OG, that we would have the other G, Doc G, who's horrible at trivia and horrible at game shows, come on. And this dude gets 2 points for you.
Well, I was on his phone. I was texting him while the game show was going on to give him the answers.
Yeah. I'm going to say something that's probably going to cause problems now because I am, in fact, a trivia host.
You are a trivia host.
And a trivia champion. So now when I go down hard, it's going to look even worse.
You haven't heard trivia like this before, Miranda.
Oh, Miranda's heard our trivia. She's like, there's been trivia.
I've played your trivia.
And then there's Stacky Benjamin's trivia, which is a whole different thing. On Monday, Wednesday, it's gettable. On Friday, well, Doug, you're celebrating another moment in history. Let's stay in the 1920s, shall we?
Hey there, stackers. I'm Joe's mom's neighbor, Doug, and longtime listeners know I love saving a dollar. Listen to some of my greatest hits. Number one, I only fill my gas tank in the morning when it's cooler, so the fuel is more dense. It's dense. Okay, sure, it's only...
Jesse's an engineer. He understands that.
It only saves a fraction of a penny every fill-up. But I mean, like over 50 years, it adds up. It adds up. Number two, I don't buy luggage. I just wear all of my clothes on the plane. Sure, I look kind of like Michelin Man going through TSA, and the people in the next seat aren't super comfortable with how much I sweat. But hey, $35 is $35. I'm a savings ninja. Well, not even Doug thought of the amazing hack people were deploying to save money before today's date in 1920. That's the day the U.S. Post Office finally said that children could no longer be sent through the mail. Oh, those were the golden days when you used to be able to do that, wasn't it? I'm not making this up, people. Here's today's question. Before that ruling, what was the maximum weight your husky tubby child could be, and the post office would still send them? I'll be back right after... Anybody else here wear huskies as a kid? I'll be back right after I try to Venmo myself from the past so I can get some compound interest like in reverse. I'm going to be rich.
Oh, wow. I can't wait to see how that plan unfolds. This might be the most bizarre trivia we've ever done. So, OG, let's say it's 1920, you're mailing your kid, or it's 1919, you're mailing your kid. What's the maximum weight the post office would allow for that to occur?
Okay, so let's assume if you were 12, you could probably get your own train ticket or horse ride or something. So this is going to be reserved for just the smallest, littlest kids.
The ones who couldn't argue.
I mean, they were working at 12, right? So these are 6-year-olds.
I don't want to go.
Yeah, you're going to grandma's for the summer. No, not the post office.
And if they complain too much, you put the stamp right over their mouth.
Yeah.
Yeah. I'm going to say that it was, the maximum weight was 45 pounds.
45. Oh, Jesse doesn't like that. Jesse, you're up next, man.
You're on mute, buddy.
Thank God.
Sorry, buddies. I was thinking about Doug's cold gas tank, and as the day heats up, just the pressure building inside that so that Doug can save a penny. But no, I like OG's theory because, okay, our daughter is 1 and she's like 25 pounds. And I don't think the number is that low because the idea of the post office signing up to mail like 1-year-old children just doesn't make sense logistically. So like OG, it's like 4-year-olds and 5-year-olds and that kind of thing. I'm going to go with 60 though. 60 pounds is what I'll say.
60 pounds. So Miranda, we got 45. We got 60.
My guess is it's increments of 10s, but I think 60 is too high. And I'm going to go with 50. I think because when you're talking back in the day, right, you got mail going by coach, and 4, 5, 6-year-olds, 7-year-olds, those kids, you can send them on a coach. You can get them a train ticket at that young age. Like when you're talking the 1920s, like childhood as we think of it didn't really exist.
Yeah, but still you're thinking about it, like Jesse said, mailing your 2-year-old.
Yeah, but they're not going through the mail, right? They're getting put on a train, and then some, creditable U.S. Postal Service employee is carrying them about. I'm going to say 50 pounds because it's got to be something that a Postal Service carrier can just like put on their hip and just like go around. I'm going to say 50 pounds. Like right when you've got a thing that says must be able to lift 50 pounds. That's the thing. I'm going to say 50 pounds.
50 pounds. All right, guys. We got 45, we got 50, we got 60. Doug, no Chelsea Brennan. Everybody playing nice today. I don't know what's up with that, but we're going to find out who's closest in just a moment.
Insurance isn't one size fits all. That's why drivers have enjoyed Progressive's Name Your Price tool for years now. With the Name Your Price tool, you tell them what you want to pay, and they'll show you options that fit your budget. So whether you're picking out your first policy or just looking for something that works better for you and your family, they make it easy to see your options. Visit Progressive.com. Find a rate that works for you with the Name Your Price tool. Progressive Casualty Insurance Company and Affiliates. Price and coverage match limited by state law.
What would you do if your online store converted 36% more shoppers? You could take 36% more vacation.
Another pina colada? Yes, please.
Open a new retail location with 36% more square feet.
Fantastic.
Hire 36% more help.
You're hired and you're hired.
Shopify has the world's best converting checkout, up to 36% better than other e-commerce platforms. What you do with those extra sales is up to you. Switch to Shopify today at shopify.com/listen and get a $1 trial. Shopify.com/listen.
Did you know Fast Growing Trees is America's largest and most trusted online nursery with thousands of trees and plants and over 2 million happy customers? Whether you're planting fruit trees, adding privacy, brightening things up with flowers, or bringing in houseplants, Fast Growing Trees has it all. Even better, they can help you find options that are right for your climate, your space, and lifestyle. Click Order Grow. Every plant arrives healthy with the Alive and Thrive guarantee straight to your door. So if you're ready to get planting, this is the moment. Right now, they have great deals on spring planting essentials, up to half off on select plants. And listeners to our show get 20% off their first purchase when using the code WWO at checkout. That's an additional 20% off. Better plants and better growing at fastgrowingtrees.com using the code WWO at checkout. Fastgrowingtrees.com, code WWO. Now's the perfect time to plant. Let's grow together. Use WWO to save today. Offer is valid for a limited time. Terms and conditions apply. Go to growingfasttrees.com for details.
OG, you started this shindig at 45 pounds, and both Jesse and Miranda said they think you're a little low. What are you thinking?
I just picked a number. I never thought about mailing my children, so I can't.
I had days back in the day. Jesse, you said 60 pounds because you couldn't imagine it being much lower.
Yeah, and I couldn't imagine it being much lower than OG's guess. So I said, I want to give some space. That's, some tactics come into play, right? I didn't want to go 46 because then Miranda could just sandwich me and by guessing 47. So I had to give enough space to encourage the field goal, which, Miranda, you bit. But maybe you'll end up being right.
I don't know. Miranda, you feeling good?
I'm feeling pretty okay because I'm just thinking in terms of like, when is a child walking? What are you going to be carrying, right? A 60-pound child, most 60-pound children can walk. You don't need to be able to carry them. So I think that's too much.
Doug weighs nearly 60 pounds now. You're getting there, aren't you?
I weighed nearly 60 pounds when I was born.
I'm just thinking about it in terms of the fact that, I raised a whole human. I did this once.
That's right. We have one mother and two dads who are guessing here. Let's see if the mom gets it or one of the two dads gets it. Doug, who's going to win this thing?
Well, hey there, Stackers. I'm Venmo lover and guy who no longer believes in time travel, Joe's mom's neighbor, Doug. Today's question was about mailing children, which can save you a ton of money. But alas, that service was decommissioned on today's date back in 1920. I do have some other hacks you can borrow, though. First, you know how expensive hair dryers are these days? I've reverse engineered the hand dryer at the gas station to blow dry my hair. Instant savings in that 30-second limit. Please, I've been training for this. And how about this one? Nobody yet has figured out the huge cost of birthday candles, especially for a guy as old as Joe. Well, I did. I did right here. You can get hundreds of uses out of a single candle by blowing out all the candles for the birthday boy before we finish that stupid song. I mean, we all know how it ends by now, right? Just light them, blow them out, move on. You're welcome. But let's get today's trivia answer, shall we? What's the maximum weight ankle biter the post office would send for you before banning the practice? Well, I'll tell you this. It was 10 pounds less than what Jesse guessed and 5 pounds more than what OG guessed.
Wow.
Meaning Mala, that's the new name for Miranda / Paula. Mala has nailed it right on the head.
Miranda.
Do I get extra points?
Right on. Bam. No, you get a high five right there. Nice job. I didn't think about the fact I was bringing on the trivia champ, but I knew that you're a trivia host, Miranda. That's got to be a fun thing to do, by the way.
It is. So I have 2 side gigs now in real life, trivia host and bartender twice a month for Bottomless Mimosa Day on Sunday.
She should have been bartender for this roundtable.
And between those 2 things, now that pays for all of my entertainment and booze for the month. It's perfect.
Fabulous.
Perfect.
It's as if you dreamed it. There was a lot of strategery there. Yeah. All right. And that means Paula now tied with Jesse. And the coalition, Jesse, is back in action.
Here we go.
I love you, Paula.
All right. Let's go to the second half of this discussion. And as I mentioned, if you want to talk about the World War II era and all of the lessons there, go read this piece. We'll link to it on our show notes. But we're going to go to inflation, Vietnam, and Watergate. The Morningstar piece reads, 1973, Middle Eastern members of OPEC imposed an oil embargo on the U.S., which led to severe inflation. On top of Vietnam withdrawal and political uncertainty after Watergate, there was a 51.9% stock market gain, which would have brought a $100 investment down to $48.13. And it took, again, like these other ones, more than 9 years to recover. This is a time, OG, when I think about this, up until just a couple of years ago, if you said inflation, nobody was paying attention, right? I mean, before the pandemic, like what's inflation? And then all of a sudden now inflation's on everybody's mind. But truly, when you think about inflation, big lesson from the 1970s, because even when you got back to $100, your $100 was no longer worth anywhere near $100 9 years later.
Right. So the only place that you can invest to keep up with inflation is in the actual products that are causing the inflation. So you have to own the companies that are causing the inflation. When you get back to even money and you're like, it's been 10 years, I'm still in the hole, it eventually will catch up again. Even with a huge inflationary period in the 70s, even with a pretty large inflationary period in 2021, 22-ish, 23-ish time, recently, we still are pretty comfortable with saying the average inflation is 3 to 4% a year. So there's periods of time where it's going to be really high inflation time and really low inflation time, and really high stock market growth and really low stock market growth, or negative. So those things just come and go. And from a cycle standpoint, the only thing that matters is, from an investment perspective, what are your investment choices during those different types of cycles? And the reality is that the only thing you can invest in that keeps up with inflation is the thing that's causing the inflation. You have to be the owner of those things. It sounds really grotesque to say, I'm owning the thing that's causing the problem. But I mean, you're not.
It's like a flotation device, though, the way I think about it.
You are, you're not. But
right?
You know what I mean?
It totally is like a flotation device. Miranda, this is where I want to turn to you, because, oh my goodness, did we have headlines during this period? I mean, we've got the Vietnam withdrawal, we've got Watergate, Nixon stepping down, and then the OPEC stuff. And then, in the late 90s, when we're finally pulling out of this, we've got the crisis with the hostages in Iran. I mean, we've got all of these headline after headline after headline through this period. This is why I think something you said earlier really works. For me, this is why you're like, buy the index, forget the headline.
Yeah. I mean, really, you look today, right? I just went ahead and pull up Market Watch today, and the Dow is down again. I mean, it's still up on.
Yeah, sure.
I don't know. Whatever, man. But it's been very volatile this year. January 20th, it's been extremely volatile. The stock market has. Every day you've got somebody going, sell before this big announcement. Oh no, buy the dip, do this. It's very stressful. And so I'm a big fan of staying the course. I made it was just like a really short video, because I had somebody message me and say, like, what do you recommend to do with stocks right now with all these headlines and the stock market volatility? What do I do? And I wrote back, I said, you stick to your plan, keep staying the course. Because over time, and we've seen on the chart, it recovers, and our entire system is set up for it to recover. Like, that's what we focus on in our system and our society. We focus on making sure that eventually the stock market recovers.
And you're doing that Miranda, buying the things, to OG's point, that cause the problem.
Yeah. And so it's like, okay, so just if you're dollar cost averaging and you have a plan, keep that up. If you're a little bit concerned about like, okay, I need a little more liquidity in my life. Okay, fine. Maybe you pull back on and only invest about half of what you've been, like if you're dollar cost averaging, if you're feeling uncomfortable about it, sure. Say, okay, I want to build some of my cash reserves a little bit and we'll reduce what I'm putting in the stock market, but keep staying the course, keep that dollar cost averaging going because the lesson we've learned through all of this is if you had just stuck in the market from the 70s on, your money, $20 million.
Yeah, holy cow.
Stick to your plan.
Yeah.
And I become kind of a little bit of a financial nihilist at this point because I'm like, it's either going to be fine and we're going to work it out and it'll be fine, or it's not. And like I said earlier, money, whatever that means, whatever money means to us, isn't going to mean the same thing.
I've always had that point of view. It's either the economy is going to, you have to make one bet in our system, and that's that the economy is going to continue. And if you believe that, then you're good.
Yeah. And if it doesn't continue, well, then it doesn't matter how much you have in cash or stocks or wherever, because none of it's going to matter.
Jesse, I think another lesson from this is in how you create your financial plan. You and I have seen some young fire advocates that are using some numbers just based on like the last 15 years that truly, as an older guy, are just ridiculous. And all you got to do is look back at this period in the 70s to go, maybe you need to rethink this huge withdrawal rate you're contemplating. Maybe you need to forget about the 12% return that Dave Ramsey says he's going to help you get. I feel like the 70s is proof that the assumptions you put in your plan are super important.
100%. And it's the cool lesson from the 70s or the Great Depression or the silver litigation. What was it called earlier that I've heard to? No,
agitation.
The cool lesson, agitation.
Silver agitation. Yeah.
The cool lesson from this Morningstar article is the fact that, sure, if you're thinking about a 30 or 40 or 50 year period, you kind of get this broad scope that you get to look at. But especially for the early years in our retirement, like we know there's this sequence of returns risk that can crop up at the worst time, which is usually the beginning of your retirement. And if you don't really have that as part of your plan, how you're going to deal with that sequence of returns risk, and if you're depending on the market to continue growing at 12%, like you just said, Joe, and if you're depending on inflation to remain low, and if that's the thing that has to happen at the beginning of your retirement to lead to success, you might be setting yourself up for trouble. And you should plan for this idea of, what if the 1970s were to repeat itself? What if the lost decade were to repeat itself at the beginning of my retirement plan? How do I get through in that case? And if you can't get through, you might want to readjust.
We covered a lot of the lessons from this last period I want to talk about, but there still are a couple looming. And this is what they call the lost decade in this piece. And they take two busts and put them together. The dot-com bust and the global financial crisis, kind of like the field goal at the ends of this 10-year period or longer, 13-year period, really. The Morningstar piece says the dot-com bust began when overinflated prices in internet and technology companies hit a breaking point, losing nearly all the gains they previously made. $100 investment in August of 2000 would have declined in value to $52.76. That's invested in the S&P 500. 7 years later, the stock market had almost gotten back to its previous level, 95.25, when the housing bubble burst and mortgage-backed securities began experiencing losses, leading to the Great Recession, in which the investment declined in value back to $46. Altogether, this 12-year period included a 54% decline. The thing I find interesting about this one, OG, is we start off with this run up in the late 90s, right? You got to get in the internet. Everybody's got to get in the internet. And what did we do when the internet blew up? We went to the thing we thought was the safest place we could be, real estate, because they ain't making more real estate. So it doesn't seem to me to be far-fetched to think that these two blew up, boom, one, and then the other one.
There's always some sort of apocalypse, du jour. There's always going to be some area that is overbought, oversold. I don't even know the right terminology, but something that's going to be too much. And just like you said, Jesse, about Warren Buffett saying that the only way to get a price sometimes is to be the lowest price so that hopefully you can get rid of your stuff, and that sometimes there is no price that's too high a price to pay for things. And we see that, in our major metro area as it relates to housing, generally speaking, we're somewhat immune to it. I feel kind of weird because people say like, oh yeah, housing market really, sucks right now. And I'm like, where? Not here. Like my neighbors sell their house in 2 days for 10% over asking. Like done. It's not even You know, like, did you hear that house? It was on the market for 7 whole days. Oh my gosh, what's wrong with it?
What's wrong with it? It's a whole week.
Yeah. It sat there for the whole week. You know, the chickens come home to roost here too, eventually, I suppose. So, I mean, I think the overarching the overarching lesson out of all of this stuff is you can't predict or control when markets are going to do whatever they're going to do. You certainly don't have any crystal ball. No one does, to know that today's the high water mark or tomorrow's the lowest point and you should act accordingly. And you can't predict not only when it's going to happen, but to what stuff it's going to happen to. So your only defense is to own everything all the time and just keep it that way. Just own one of everything. It's just too easy to just say, well, I don't have to play the game. Like Miranda said, I don't take too much bandwidth. It's like, I'd rather do trivia or do whatever, right? It just takes too much bandwidth to do it. Just own one of everything for all eternity.
I got wine to drink, kids. I got wine.
You're not wrong, sister. Preach. Yep. So, just choose the simple path.
I think this was, Miranda, a period where I think we learned that volatility fatigue is a real thing, because I just think back and you're like, oh, okay, I'm going to buy the dip. Like if you thought you were smart and you bought the dip in 2002, goes up for a little bit and then damn it, we're almost back to normal and we get another dip. Like I can see people learning the wrong thing if you're going to always try to buy the dip.
Yeah. And it's just, you don't know, okay, well, is this what happens if the dip is worse the next day?
What if there's a dippy dip?
Yeah, exactly. We could have a
double
dippity dip. We could have a dippity dip.
Triple dip?
Who knows?
It's like an ice cream
could be
cone?
dips for days.
Is this where double dipping is actually appropriate?
Oh my gosh. Well, no, because you already spent all your money on the first dip and now you don't have any money for the second dip.
That's
out
right.
Of dip money.
Good point.
Like
the truck is backed up. It's already been backed up. Yeah. Jesse, let's go around the horn and talk about some of the just lessons from all of these. What's kind of an overarching lesson you got reading this piece that I think is good for us to end on?
Yeah, the overarching, going back to the beginning, the up and to the right trend is impossible to ignore. And that is I think the first trend that many stock investors have internalized. And if you haven't, it behooves you to internalize that lesson. But then the second one, my second big takeaway, that even in this last discussion of the great financial crisis and going back to the Great Depression, it's hard to put into words what it was like to live through or invest through those times. It's hard to say just wait 16 years and you'll be back above water, right? And it's not just your stock portfolio, because that's the really, Great Depression, it was unemployment too. So your cash flow no longer exists and your portfolio is down for the people who invested then. That's a tough one because maybe it doesn't apply that much to modern day. But the great financial crisis, if you might lose your home and you also lost your job and your 401k is down 50% at the same time, that is really hard to deal with. And it's hard. I mean, I'm not even sure I can fully empathize and put myself in that position.
Well, and for some people, Jesse, it was even deep. Smart people lost jobs. They lost their homes.
Yeah. So that's what we're talking about here. So it can really happen, and it can take a little while to recover from that. And so I think from that kind of holistic financial planning point of view, that's my big takeaway, is to realize that this is more than just, my portfolio went down, I should buy the dip. It'll recover in a year. It's more than that. And we need to open our eyes to that fact.
Miranda, put an and on the end of that. And we should have also learned this.
Well, yeah, I mean, stay the course. And I think Jesse makes a really good point, because we talk a lot about, we'll keep it in the market. Don't panic, don't sell. It also means preparing, where are you at in your community? Where are you at with your resources? Do you have community that you can rely on, community networks that you can turn to? Because if you think that it really is going to be a long-term issue, right? If you feel I am at risk, if everything goes to crap, if we have another Great Depression and I can't get a job and I deplete my savings and I lose my house and everything's, whatever, what are the other resources do I have to rely on? What are my personal networks?
Well, and this is what's cool, because Miranda, we've known each other for a long time. Yeah. And the fact that you have these side hustles, when frankly, knowing a little bit about you, you don't quote need them, but to be able to go out and do these other things and create income is a huge skill that if the market's down for 16 years, the ability to go back and turn and do something else, I think is a big thing. Let's get OGs before we say goodbye. OG, what's another takeaway, big overarching takeaway from this?
I had my big overarching takeaway. I had my moment earlier. I'm out of ideas.
You just go, ta-da, 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 ta-da. And that overarching takeaway was
diversify. Yeah.
Diversification.
You know, not the day nor the hour. So own one of everything forever.
I just want to say, as long as you can, just this graph also makes a great chart about why that automatic investment plan, not just diversification, but that automatically putting the same amount in every month really, really helps. Like, wow.
Yeah. That's a really good point, Joe, because this chart, again, this shows the $1 invested in 1870, and then it just shows the value of that $1 inflation adjusted over time. If they could recreate this chart and say, put in $1 more every year, or like inflation adjusted, almost like turn it into a DCA chart, those long periods of no return, that 16-year period where you're like, oh, that period fundamentally changes if you're dollar cost averaging through it. And I think that'd be a really powerful chart to make. So Morningstar, if you're listening,
there it is.
Here first.
Your next assignment. When we got you next time at Morningstar, we'll talk to our friend Christine over there. All right, everybody, that's going to do it for today. I love walking through history. I loved every minute of this episode. Thank you so much for hanging out with us, Stackers. Let's find out what's going on where you all are. We'll have our guest of honor go last. OG, what's going on this fine weekend in the middle of June?
Oh, packed. Tomorrow is couples golf tournament. So really look forward to that. The wife played pretty good in her last golf tournament. So we're going to kind of, we'll see what happens. So optimistic about that. And then the 15th on Sunday is our 23rd wedding anniversary. So
wow,
we will
congratulations.
be doing absolutely nothing because 23rd is nothing.
It's nothing, so that means we do nothing.
Exactly.
That's great. Well, the fact that she's put up with you for that long is just a testament to longevity and being able to stick with it. Stick with it.
Stick-to-itiveness.
Jesse Cramer, what's going on at the Personal Finance for Long-Term Investors podcast?
Well, I think, first off, for every anniversary, there's a gift. And I think 23rd is lead. So maybe some pellets or some pre-1974 paint chips, OG, could be a really nice gift.
Maybe some fluctuating silver.
Get some ammo for your gun. Get some ammo for your gun.
Some agitated silver could be a wonderful 23rd as a anniversary gift.
Saving all my money for my 25th.
Last weekend, we celebrated our daughter's first birthday, so that's pretty exciting. On the podcast, though, last week, we had our 7th AMA episode, and next week, we have a fun episode featuring 6 celebrities, including Joe, to tell us some fun spending stories. I'm calling it the Keeping Up with the Joneses episode. So we have some really cool spending stories.
On this episode?
That is true. If you really want spending, I should have deferred to
Holy
OG.
Crap.
He's like, here, hold my beer.
Do you want to know so while we were talking, I had to jump on ChatGPT real quick and I wrote, here's my spending plan for the next month. What is my optimal credit card strategy for points? And ChatGPT gave me a big long list of how best to allocate my spend for the next month on my credit cards.
ChatGPT said, cut up the cards, OG.
It said, hey, knucklehead, weren't you just talking about investing in dollar cost averaging? Why don't you save a few bucks?
What the heck's going on there? And I love, Jesse, some of the love you've been getting from our stackers in Mom's Basement, but they also said they've had a little trouble finding the show. So if somebody's having trouble finding the show, you were encouraging, like, don't give up. Your show exists.
Yeah, it does. And so here's the funny thing. It exists on all podcasting platforms. As far as we're aware, the specific platform in question in the basement was Pocket Casts. And the funny thing is Pocket Casts syndicates directly from Apple. So as long as you're on Apple, which is the strongest platform for me, then we're on Pocket Casts. That said, in defense of the stackers, I know they're onto something because 3 unique people are like, yeah, Jesse, we can't find you on Pocket Casts. So clearly, if it was one stacker, no offense, Joe, I'd be like, okay, this person doesn't know what's going on. But the fact that it's 3 means like, okay, there's only like a 50-50 chance that 3 people don't know what's going on. I'm kidding. But something's going on there. But still, thank you for searching. Definitely on Apple, Spotify, all the big ones. And we should be on a lot of the small ones too.
That is good to hear that you are out there. So stackers, keep on looking for Personal Finance Podcast for long-term investors. Miranda, great seeing you again. It's been so fun.
Yeah, thanks for having me on. It's been a minute.
Well, so everybody goes to mirandamarquit.com, mirandamarquit.gumroad.com, and they will find some of your mini courses.
Yeah. So just head on over there and you can access the mini courses. I do have a couple seasons of a podcast I did with Sarah Lee Kane called It Doesn't Make Sense. And that's sense with, a C because we're so clever. But
my first show in Detroit was called Dollars and Cents.
Yeah.
S-E.
Yeah.
NSE.
And it's kind of fun. We just did a couple seasons of that, and then we had some life stuff. So we're just kind of we're on hiatus for a minute, but like it was kind of a fun thing to just take regular personal finance advice and just be like, okay, well, how can you do it different? But this weekend, I get to do politics, and then we're having a graduation party for my son.
Wow! Congratulations!
And this is his associates, not high school. We already did that
degree. Man, college. We've had all over the place, different college degrees, high school.
Yeah.
Pretty soon, Jesse's going to be going to a kindergarten graduation in a few years.
Preschool first.
Those are such a waste of time, Jesse. The kindergarten graduation. You're like,
just
really?
trying to get out of it, buddy.
Yes.
It's not that great.
No, we've already got all the decorations. No, I'm kidding. I agree with you. Sorry to any parents out there, but I'm not going to be throwing any big graduation parties if I have a say in it.
He's already hired.
You don't, by the way.
For kindergarten, that is. For kindergarten.
He's already hired Beyonce for the party afterwards.
Yeah.
All right, stackers. What are your lessons from history? Let's hear yours. Either email me, joe@stackingbenjamins.com for a future episode, or go to our Facebook page, The Basement, and that'll be a lot of fun. Doug, take it from here, man. What should be on our to-do list?
Well, Joe, first, take some advice from Miranda Marquit. I think she said, be a lazy investor who knows how to trap your own food. Seemed to work for her. Did I get that right, Miranda?
It's an audio podcast.
Yeah, works for me. I didn't know you were going to ask me a thing again.
Miranda was giving the thumbs up.
I've been gone so long. Yes. Learn some extra skills on top of being lazy and as an investor.
Second, Jesse told us to plan for the sequence of returns risk early in retirement. Jesse, in 15 words or less, how exactly do we do this?
Wow, you really are an
Just seeking to understand.
Build a buffer of lower risk assets for the early years. F.U. Douglas. 15.
Oh, that's going in the Hall of Fame right there, baby. That was fantastic. But the big lesson, if you're going to try to save money by making your own toothpaste, maybe don't store it in the same kind of jar as your grout cleaner. Lesson learned. That one's on me. Ugh. Thanks to Miranda Marquit for joining us today. Miranda offers excellent mini courses and financial coaching, which you'll find at mirandamarquit.gumroad.com. We'll also include links in our show notes at stackingbenjamins.com. Thanks to Jesse Cramer for hanging out with us today. You'll find his fabulous Personal Finance for Long-Term Investors podcast on at least 66% of the services you're trying to look for him on. So just keep at it. You'll stumble into him sooner or later.
Someday. Everybody's got a dream.
Thanks also to OG for joining us today. Looking for good financial planning help? Head to stackingbenjamins.com/OG for his calendar. This show is the property of SB Podcasts, LLC, copyright 2025, and is created by Joe Saul-Sehy. Joe gets help from a few of our neighborhood friends. You'll find out about our awesome team at stackingbenjamins.com, along with the show notes and how you can find us on YouTube and all the usual social media spots. Come say hello. Oh yeah, and before I go, not only should you not take advice from these nerds, don't take advice from people you don't know. This show is for entertainment purposes only. Before making any financial decisions, speak with a real financial advisor. I'm Joe's mom's neighbor, Doug, and we'll see you next time back here at the Stacking Benjamins Show.